Imagine walking into a dealership and seeing the price of your dream truck slashed by over 35%. Unbelievable, right? Stellantis, the parent company of Jeep, Dodge, and Ram, is flipping the car market upside down with massive MSRP cuts across their lineup. With inventory piling up and competition heating up, they've made a move no one saw coming, offering deals that could force the entire industry to rethink its pricing strategy. Why are these discounts happening now? What does this mean for your next car purchase? And could this be the beginning of a price war that changes everything? What's happening? 35% off MSRP. Sounds too good to be true, right? But that's exactly what Ram and Jeep are doing, flipping the car market on its head. The announcement is sending shockwaves across the auto industry. Ram and Jeep, two of the most iconic brands under Stellantis, have declared a bold strategy to cut prices by up to 35% on their new and existing inventory. This isn't just about a seasonal sale, it's a desperate move to clear out overwhelming stockpiles of unsold vehicles. Imagine walking into a dealership and finding a brand new Ram 1500 or Jeep Gladiator priced like a mid-tier sedan. Sounds unbelievable? That's the reality unfolding. Stellantis is taking dramatic steps to address its growing crisis. Overstocked lots, falling sales, and frustrated dealers. This isn't just about unsold 2024s or 2025s. The problem goes back even further. Dealerships are still housing some 2022 models, vehicles that have been gathering dust for years. For Stellantis, it's now or never, but why now? And what led Stellantis to such a drastic decision? Let's dive deeper into the chaos that brought them here. What's on sale? From entry-level Jeeps to the top-of-the-line Durango Hellcat, Stellantis is slashing prices across the board. It's not just one or two models getting the discount treatment, it's nearly everything in the lineup. Base models like the Jeep Compass and Ram Tradesman are seeing price reductions that make them accessible to a whole new demographic. High-end models, including the Durango Hellcat and Jeep Grand Cherokee Summit, are also part of the deal, offering savings that are unheard of in the luxury SUV segment. For example, reports are already circulating about brand new Ram 35,000 Tradesman trucks selling for under $40,000. That's a truck that was priced closer to $60,000 just a year ago. Similarly, Jeep Wrangler Rubicons, once retailing for over $75,000, are now being offered in the low 30s. This level of accessibility is a dream for consumers, but raises serious questions. Is Stellantis sacrificing profitability for the sake of clearing inventory? And what does this mean for the long-term value of these vehicles? If it feels like Stellantis is hitting the panic button, that's because they are. But what led to this crisis? The answer lies in a series of costly mistakes. How did it get this bad? How does one of the world's biggest automakers end up with years of unsold cars? The answer isn't pretty. Stellantis' current situation is a textbook example of what happens when poor strategy meets an unpredictable market. Over the past few years, the company focused on high-margin, low-volume sales. By raising MSRPs on popular models by as much as 45%, they hoped to sell fewer vehicles at higher profits. It was a gamble, and it failed spectacularly. As prices skyrocketed, customers began looking elsewhere. Competitors like Ford and GM capitalized on the opportunity, offering more affordable alternatives. Meanwhile, Stellantis continued to churn out vehicles, creating a backlog of unsold inventory that has become nearly impossible to clear. Leadership changes only added to the chaos. Former executives prioritized short-term gains over long-term stability, leaving dealerships drowning in inventory. The arrival of Tim Kuniskis and Antonio Filosa marked a turning point, but even they couldn't undo the damage overnight. Adding to Stellantis' woes, economic factors like rising interest rates and inflation have made consumers more cautious. When faced with a $50,000 truck or SUV, many buyers simply walked away. The result? Rows of unsold vehicles, some so old they're showing signs of wear just from sitting on the lot. With their backs against the wall, Stellantis had to act fast. But what do customers think of these drastic measures? Let's find out. The customer reaction. Excitement, frustration, and confusion. How are consumers really feeling about these record-breaking discounts? For new buyers, this is a dream come true. The idea of owning a Ram 1500 or Jeep Grand Cherokee at a fraction of its original price is enough to make anyone excited. Social media is buzzing with posts from people boasting about the deals they've snagged. Some are calling it the best time to buy a truck or SUV in years. But for those who purchased a Stellantis vehicle in the past 2 years, the reaction is very different. Depreciation inflation is hitting hard, with many owners realizing their vehicles are now worth significantly less than their loan balances. Imagine buying a $60,000 Ram 35,000 in 2023, only to find the same model selling for $40,000 just a year later. For these customers, frustration doesn't even begin to cover it. Dealers are also feeling the heat. While the price cuts are helping move inventory, they're dealing with an influx of trade-ins that have lost significant value. The used car market, already volatile, is bracing for another shakeup as these discounted models flood the market. This is just the beginning. With Stellantis disrupting the market, competitors will have to respond, and the impact could be massive. Before we dive even deeper into how Stellantis' massive discounts are reshaping the auto industry, take a moment to show your support. If you're loving the shocking details so far, hit that like button. The volume game returns. When profits plunge, what's the solution? Stellantis says, sell more for less and sell fast. Stellantis has turned back the clock to the golden days of automotive sales, embracing the volume game once again. The company is moving away from the recent trend of pushing luxury-priced vehicles with sky-high profit margins and shifting its focus to mass-market affordability. Why? Because customers aren't buying what Stellantis has been selling, literally. Over the last 3 years, the average truck or SUV price skyrocketed across the industry thanks to supply chain issues and inflated demand. Automakers, including Stellantis, capitalized on this by hiking MSRPs, believing the market would support these higher prices indefinitely. But as the world returned to normal, so did consumer expectations. Buyers were no longer willing to shell out $80,000 for a Ram, $1,500 or $75,000 for a Jeep Gladiator, and Stellantis felt the backlash. The shift to a volume-based strategy isn't just about affordability, it's about survival. By lowering prices, Stellantis is betting that moving vehicles in bulk will stabilize its operations, clear out bloated inventories, and restore confidence in the brand. This is particularly critical for Stellantis, which has long struggled to maintain consistent sales momentum across its Ram and Jeep divisions. But how does this play out in a competitive market? To understand the stakes, we need to examine the mounting pressure from Ford, GM, and other rivals. The competitive pressure. When one player drops their prices by 35%, everyone else feels the heat. Is this the start of a price war? Stellantis' decision to slash prices isn't happening in a vacuum. The US truck and SUV market is dominated by fierce competition, with Ford, General Motors, and Toyota constantly battling for dominance. A massive price cut by one automaker sends ripples and sometimes shockwaves through the industry. For Stellantis, the price cuts aren't just about clearing out inventory. They're also a calculated move to steal market share. Imagine this: a customer walks into a dealership looking for a Ford F-150, only to find a similarly equipped Ram 1500 priced $20,000 lower. It's a no-brainer for most buyers, especially when every dollar counts in today's economy. Ford and GM are already feeling the pressure. Both companies have leaned heavily on their best-selling trucks, the F-150 and Silverado, for profitability. If Stellantis' strategy proves effective, Ford and GM will have to respond, likely with discounts or incentives of their own. This could trigger a race to the bottom, where automakers undercut each other to attract buyers, eroding profit margins across the board. The stakes are even higher for Jeep, which competes directly with popular models like the Toyota 4Runner, Subaru Outback, and Ford Bronco. By slashing prices on iconic models like the Wrangler and Grand Cherokee, Stellantis is positioning Jeep as a value-driven brand. This could attract a wave of new customers, but it also risks diluting the premium image Jeep has cultivated over the years. While Stellantis' strategy may seem like a win for consumers, it's creating a logistical nightmare for dealers. Let's take a closer look at how dealerships are handling the chaos. Dealer dynamics. What happens when dealerships suddenly have to sell more cars for less money? A whole lot of scrambling. Dealerships are the front lines of Stellantis' bold pricing experiment, and they're facing unprecedented challenges. The price cuts may sound great to consumers, but they come with significant logistical hurdles for dealers. First, there's the issue of inventory management. Many Stellantis dealerships are still grappling with massive backlogs of unsold vehicles from 2022, 2023, and 2024. The addition of discounted 2025s only adds to the complexity. Some dealerships are resorting to creative storage solutions using rented lots or even grassy fields to accommodate the overflow. Then there's the question of profitability. Dealers rely on a mix of new car sales, trade-ins, and financing to stay afloat. With reduced MSRPs, the margins on new vehicle sales shrink dramatically. To compensate, dealerships are pushing harder on trade-ins and upselling financing options. But even these strategies have limits, especially when many trade-ins are already losing value due to the falling prices of new models. For dealerships, the stakes are high, but what about the buyers? Are these discounts really the game changer they seem to be, or is there more to the story? Winners and losers. 35% off sounds amazing, but who really comes out ahead in Stellantis' price gamble? On the surface, the biggest winners appear to be new car buyers. A Ram 1500 for $35,000 or a Jeep Wrangler for $32,000 is enough to make even the most frugal shopper take notice. For first-time truck or SUV buyers, this is an unprecedented opportunity to own a high-quality vehicle at an affordable price. But not everyone is celebrating. Existing owners of Stellantis vehicles are arguably the biggest losers in this equation. For them, the price cuts are a double-edged sword. On one hand, the discounts could make it easier to trade up to a newer model. On the other hand, the rapid depreciation of their current vehicles is a financial gut punch. Imagine paying $60,000 for a truck last year, only to see similar models now selling for $40,000. The frustration is palpable. Then there are the long-term implications for Stellantis itself. While the price cuts may boost short-term sales, they also set a dangerous precedent. Customers may come to expect significant discounts, undermining the perceived value of Stellantis brands. And if the company can't maintain profitability at these lower prices, it risks deeper financial trouble down the line. The strategy is risky, but it's not without precedent. Now let's talk about how Stellantis' bold moves are reshaping the entire auto industry and what it means for buyers and competitors alike. This story is too wild to keep to yourself. If you've been amazed by these game-changing price cuts, share this video with your friends and family. Who knows, you might just help someone snag the deal of a lifetime. A ripple effect across the industry. When one automaker slashes prices, the entire industry feels the shockwaves. So what's next? Stellantis' decision to cut prices on Ram, Jeep, and Dodge models by up to 35% isn't just a bold move. It's a declaration of war in the auto industry. These price cuts aren't happening in isolation. They're forcing competitors like Ford, General Motors, and even foreign automakers like Toyota and Honda to reevaluate their strategies. Take Ford, for example. The F-150 has long been the best-selling truck in America, but that crown is now under threat. When a Ram 1500 is priced $20,000 lower than a comparable F-150, customers start asking hard questions. Is the Ford badge worth the premium? Does the F-150 offer enough extra features to justify the cost? Ford dealerships are already feeling the heat, with some dealers quietly increasing discounts to compete. However, Ford's higher production costs and reliance on premium trims make it harder for the company to match Stellantis' aggressive pricing. General Motors too finds itself in a bind. The Silverado and Sierra are beloved by truck enthusiasts, but they've also seen price hikes in recent years. Now, GM must decide whether to stick to its current pricing strategy or risk cutting into its profit margins to stay competitive. The stakes are even higher in the SUV market, where the Jeep Grand Cherokee's price cuts threaten to lure buyers away from Chevy's Blazer and Traverse. But while competitors scramble to adjust, Stellantis faces another challenge: ensuring these price cuts don't backfire. What are the risks of such an aggressive strategy? The risks of going all in. When you gamble big, you can win big or lose it all. So what's at stake for Stellantis? On the surface, Stellantis' strategy seems like a win-win. Lower prices attract more buyers, move inventory, and generate buzz around the brand. But this approach comes with significant risks, and the company's future hangs in the balance. The first risk is profitability. By slashing MSRPs by up to 35%, Stellantis is taking a massive hit to its profit margins. Trucks and SUVs are among the most profitable vehicles for automakers, and any reduction in their price significantly impacts the bottom line. While selling more units can offset some of these losses, there's no guarantee that volume alone will make up the difference. Inventory management poses another challenge. While price cuts help clear out older models, they also risk creating confusion among buyers. Some customers may wait for even deeper discounts, while others may hesitate to buy new models if they believe prices will continue to fall. This creates a delicate balancing act for Stellantis and its dealers, who must maintain sales momentum without devaluing their products further. With these risks in mind, Stellantis is betting on one key factor to make this strategy work: consumer loyalty. But can they deliver enough value to keep buyers coming back? The appeal to value-oriented buyers. What do today's buyers really want? Stellantis is banking on one answer: value. In an era of rising interest rates and economic uncertainty, consumers are more cost-conscious than ever. Stellantis understands this and is tailoring its pricing strategy to appeal to buyers looking for maximum value. But delivering value isn't just about offering the lowest price. It's about creating a package that feels like a smart investment. For Ram, this means emphasizing capability and reliability. The Ram 1500 has long been praised for its smooth ride, luxurious interior, and impressive towing capacity. By offering these features at a significantly lower price, Stellantis is making it easier for buyers to justify choosing Ram over competitors. A $35,000 Ram 1500 with advanced safety features and a powerful engine feels like a steal compared to a $56,000 Ford F-150. Jeep is taking a similar approach, highlighting its off-road capabilities and iconic design. Models like the Wrangler and Grand Cherokee are marketed as versatile vehicles that can handle both daily commutes and weekend adventures. The price cuts make these models more accessible to a broader audience, including younger buyers who may have previously considered Jeep out of their budget. Dodge, meanwhile, is focusing on performance enthusiasts. The Dodge Charger and Challenger, known for their muscle car heritage, are now more affordable than ever. This could attract a new generation of drivers who want high-performance vehicles without breaking the bank. But Stellantis isn't just catering to individual buyers. Their strategy is also shaking up the fleet market, a key battleground for automakers. The fleet market opportunity. Fleet sales, the unsung hero of the auto industry and Stellantis' secret weapon in this pricing war. While individual buyers are the most visible part of the market, fleet sales represent a massive opportunity for Stellantis. By slashing prices, the company is making its vehicles more attractive to businesses, government agencies, and rental companies that buy in bulk. Fleet buyers prioritize affordability, reliability, and total cost of ownership. Stellantis' price cuts check all these boxes, especially for models like the Ram 1500 Tradesman, a workhorse truck ideal for construction companies and delivery services. A $38,000 Tradesman is an appealing choice for businesses that need to purchase multiple vehicles while staying within budget. Jeep, too, stands to benefit in the fleet market. The Jeep Compass and Cherokee, with their compact size and off-road capability, are popular choices for utility companies and government fleets. The lower prices make these models even more competitive, potentially attracting bulk orders from organizations looking to replace aging vehicles. Even Dodge, known for its performance-oriented vehicles, has a role to play. The Dodge Durango, with its spacious interior and powerful engine options, is a favorite among law enforcement agencies. Lowering the price could lead to increased demand from police departments and other organizations. Stellantis is rewriting the rules of the auto industry, but the real test lies ahead. Can this bold strategy sustain long-term success, or will it spark a market-wide race to the bottom? Now, we want to hear from you. Do you think Stellantis' bold move will spark a pricing revolution or lead to chaos in the market? Drop your thoughts in the comments below. We're reading all of them and can't wait to hear your take. Will Stellantis spark a pricing revolution? What happens when one automaker dares to challenge the status quo? The entire industry shifts. Stellantis' bold move to slash MSRPs by up to 35% has sent shockwaves through the auto industry. It's not just a pricing strategy, it's a declaration that the old rules of car sales no longer apply. But the big question is, will this spark a broader pricing revolution? Historically, automakers have been hesitant to make drastic price cuts. Lowering MSRPs can impact brand perception, alienate recent buyers, and set a precedent that's hard to reverse. However, Stellantis' aggressive strategy is forcing competitors to reconsider their positions. Ford, General Motors, and Toyota are already under pressure to respond. A Ram 1500 priced at $35,000 leaves the $56,000 F-150 looking overpriced in the eyes of consumers. If Stellantis' strategy strategy proves successful, it could create a domino effect. Competitors may feel compelled to lower their prices to stay competitive, potentially sparking a race to the bottom. While this could benefit consumers in the short term, it also raises questions about the long-term sustainability of such an approach. Can automakers maintain profitability while slashing prices, or will the industry face new challenges as margins shrink? But pricing is only part of the equation. What does Stellantis' strategy mean for innovation and product development in the years to come? The innovation trade-off. Can automakers afford to innovate when they're racing to offer the lowest prices? One of the biggest concerns with aggressive pricing strategies is their impact on innovation. Automakers rely on healthy profit margins to fund research and development, create new technologies, and improve vehicle designs. By slashing prices, Stellantis is taking a calculated risk. They're betting that increased sales volume will offset the reduced margins and allow them to continue investing in the future. However, there's a potential downside. If profits dip too low, Stellantis and its competitors may face difficult decisions about which projects to prioritize. Electric vehicles, advanced driver assistance systems, and other cutting-edge technologies are expensive to develop. A prolonged pricing war could slow progress in these areas, leaving automakers struggling to keep up with consumer expectations and regulatory demands. For Stellantis, the stakes are particularly high. The company has already announced plans to expand its electric vehicle lineup, with models like the Ram 1500 REV and Jeep Recon EV on the horizon. These vehicles represent significant investments, and their success will depend on Stellantis' ability to balance affordability with innovation. If the company can deliver high-quality EVs at competitive prices, they could emerge as leaders in the industry. But if the pricing strategy undermines their ability to invest in future technologies, it could backfire in the long run. While innovation remains a critical challenge, another major concern looms on the horizon. How will this strategy impact dealerships and the broader market ecosystem? The dealer dilemma. Stellantis pricing cuts may seem great for buyers, but what about the dealerships caught in the middle? Dealerships are the front line of the auto industry, and Stellantis' decision to slash prices has created both opportunities and challenges for these businesses. On one hand, lower MSRPs make it easier to attract customers, move inventory, and boost sales volume. For dealerships that have been struggling to clear out older models, the price cuts are a welcome relief. However, the strategy also creates significant risks for dealers. The sudden drop in prices devalues existing inventory, leaving dealerships with vehicles that are harder to sell at a profit. Customers who purchase vehicles at higher prices in the past year may feel cheated, leading to strained relationships with dealers. This could impact long-term customer loyalty, as buyers may hesitate to trust dealerships that appear to prioritize quick sales over fairness. Dealerships also face logistical challenges as they adapt to the new pricing structure. With a flood of buyers eager to take advantage of the discounts, service departments and sales teams are under pressure to handle increased demand. At the same time, dealers must carefully manage their inventory to ensure they don't end up overstocked with models that aren't selling as quickly. While dealerships grapple with these challenges, the broader economic implications of Stellantis' strategy are even more significant. How will this move reshape the car market as a whole? The new normal in the auto market. Could Stellantis' bold gamble change the way we buy cars forever? If Stellantis' pricing strategy succeeds, it could signal the start of a new era in the auto industry, one where affordability takes precedence over exclusivity. This shift has the potential to make vehicles more accessible to a broader range of buyers, particularly younger consumers and those on tighter budgets. For years, rising vehicle prices have pushed many buyers out of the market, forcing them to rely on used cars or delay purchases altogether. By slashing prices, Stellantis is addressing a growing demand for affordability and value. If other automakers follow suit, we could see a broader democratization of the car market, with more options available at price points that were previously unattainable. However, this new normal isn't without its risks. A race to the bottom on pricing could lead to a decline in overall vehicle quality, as automakers cut corners to stay competitive. Additionally, the market could become more volatile, with frequent price fluctuations creating uncertainty for buyers and sellers alike. There's also the question of how the strategy will impact the used car market. Lower MSRPs devalue existing vehicles, potentially leading to a surge in trade-ins and repossessions. This could flood the used car market with inventory, driving down prices and creating opportunities for budget-conscious buyers. However, it could also create challenges for dealerships and lenders as they navigate the ripple effects of declining vehicle values. This is just the beginning of the auto market's most exciting shakeup yet. If you want to stay ahead of the curve and never miss the latest updates, hit that subscribe button and join us for more insider scoops.